Good afternoon, boys and girls. I'm Raymond Dahlman, your humble host here at the Liberty Call for Tuesday, February 15th, 2022. It's a fantastic day. It's my 48th birthday. Woo! I feel so old. Not really. What's weird is I still feel like well, my wife says I'm 12, but I'd say more like 15 or 16 mentally. It's kind of weird, as you get older, I graduated high school, went into the Navy, met my wife, started a family, worked a career in collections and recovery for about 8 years, and then switched over to financial advising. And, you wake up one day and you're like, holy shit, I'm in my late 30s, early 40s, and I'm still the same person. So, you expect to grow up, but you never do. So, all right. Well, I hope everyone's having a fantastic Tuesday out there. If it's your first time watching, hit that subscribe button, click, and share with friends and family. I'd greatly appreciate it. Let's take a peek and see how the markets did today. A much better day in the stock market. It's probably, because it's my birthday, obviously. The Dow Jones was up 1.22%, closing at 34,988. S&P 500 up 1.58%, closing at 4471. NASDAQ up 2.53%, closing at 14,139. Small caps are up 2.79%. VIX was down 9.28% today, which is a good thing, closing at 2570. And I see nothing but greens across the South America, Europe, or Western Europe. Where's the first red we get to? It's down in Hungary and Japan. And where's that? Australia. So we got 3 down markets. I mean, not down terribly, 169, 0.79, and 0.51. And then mostly green across the Far East markets, except for the Hang Seng and the Taiwan weighted. And then two more, South Korea and Sri Lanka. So, but as far as the day, if we look at the day or the market, for the entire globe, started out, really good in the Asia markets, excellent across, Eastern and Western Europe, and, really good here domestically here in the States. So we'll see if the trend continues. Obviously it could be, a multitude of things, tensions easing between the supposed war that's going to start between, Ukraine and Russia and our involvement in it. I think personally, it's just more of a distraction. Last I checked, we don't have a border with Russia, so I don't know why it matters. And the folks in NATO can kiss my ass. We've been paying their military bills for 50 or 60 years. So, all right, well, let's take a look at some articles in here. And this article kind of wraps up the day. Stocks rally, oil slips as Russia-Ukraine tensions ease. Written by Herbert Lash and Elizabeth Howcroft from Reuters. Stocks on Wall Street and in Europe rebounded on Tuesday when oil prices fell after Russia indicated it was withdrawing some troops from exercises near Ukraine, and President Vladimir Putin said he saw room for further discussion with the West. President Joe Biden later said that a Russia attack on Ukraine remained possible and that the United States would defend every inch of NATO territory. Joe, Ukraine's not part of NATO, so I don't know if anyone needs to point that out to your senile ass. All right. Gold and bond prices slid as safe haven assets lost some of their appeal, with tensions possibly easing over Ukraine. But NATO said it had yet to see any evidence of de-escalation, and a vote in Russia's lower house threatened a wider standoff. The State Duma agreed to ask Putin to recognize 2 Russian-backed breakaway regions in eastern Ukraine as independent and move the European Union told Moscow not to adopt. The dollar index paired losses as Putin and German Chancellor Olaf Scholz spoke. Sign tensions over Ukraine have not been resolved, but the index fell 0.294%, suggesting there was little flight to safety, especially as the euro, which had weakened recently, rose 0.44% to 1.1355. The Russian ruble strengthened 1.53% at 75.51 per dollar. In the back of everybody's minds, this is not going away. Putin might be saying one thing and just waiting for the right time to make a move, said Tom DeGalama, managing director at Seaport Global Holdings. Major stock indices rose on both sides of the Atlantic, with mega cap growth and tech stocks leading the rally on Wall Street. The major European bourses posted gains of more than 1%. The Pan-European Stock 600 index rose 1.43% after falling 3 consecutive sessions, while the MSCI's U.S.-centric gauge of global equities closed up 1.34%. On Wall Street, the Dow was up 1.22, the S&P was up 1.58, and NASDAQ was up 2.53. While the Ukraine crisis simmered, the Labor Department reported U.S. producer prices increased by the most in 8 months in January, a reminder that high inflation could persist through much of the year. I've been saying that for a while. This is not going away until interest rates are significantly higher. The Federal Reserve is aware inflation is running hot, but knows rising home prices and mortgage rates will crimp the pocketbook of many Americans, leading the economy and inflation to slow, said Peter Kramer, Senior Managing Director at SLC Management. They know they have to get inflation under control, but slowing the economic activity that will really help to do that is already starting to happen, Kramer said. A closely watched part of the yield curve, measuring the gap between yields of the 2- and 10-year Treasury notes, seen as an indicator of economic expectations, is starting to signal a sharp slowdown as it flattens to 47.1 basis points. The odds of the Fed engineering a recession are increasing if policymakers do not push back against the market narrative of 6 or so interest rate hikes in a row, Kramer said. It remains to be seen whether the Fed can get inflation under control by raising interest rates alone, Di Jaloma said. Markets are pricing in a 65.5% chance of a 50 basis point hike and a 34.5% chance of a 25% basis point hike at the U.S. Central Bank's March meeting. Longer dated U.S. Treasuries and Eurozone bond yields rose as investors took comfort from the potential easing of tensions over Ukraine and essentially ignored the PPI data. The benchmark 10-year Treasury note rose 5.6 basis points to 2.052%. Germany's 10-year yield touched its highest since 2018 on the day, possibly easing of U.S. On the days possibly easing of Russia, U.S. Ukraine tensions. Oil tumbled more than 3% as they retreated from a 7-year high. U.S. crude futures fell $3.39 to settle at $92.07 a barrel, while Brent futures settled down $3.20 at $93.28 a barrel. Precious metals also fell, with gold slipping from multi-month high and palladium shedding more than 5%. U.S. gold futures settled down 0.7% at 1856.20 an ounce. Bitcoin rose 4.33% to 44,066.83 cents, in another sign of the risk on mood in markets. So, kind of a good day as far as equities. Not so good if you're an oil or a commodities investor. But I think that's just kind of a one-day, pause. With the inflation we're seeing, who knows where the price of oil go to? Will it go up to, $120, $130 a barrel? Each Friday I do keep track of the rigs online, and we did have a big jump last week. So we'll see. It's nothing is for certain, obviously, in this world, but we'll see where things go. All right. U.S. producer prices accelerate amid broadening inflation pressures. This was written by Lucia Mutikani from Reuters. U.S. producer prices increased by the most in 8 months in January amid a surge in the cost of hospital outpatient care and goods such as food and motor vehicles. Another sign that high inflation could persist through much of this year. Broadening inflation pressures were underscored by other data on Tuesday, showing a measure of prices received by factories in New York State surged to a record high in February, while manufacturers reported they continued to pay higher prices for inputs. The report followed on the heels of news last week of a stronger rise in consumer prices in January, with the inflation rate posting its largest increase in 40 years. Financial markets have priced in better than even chances that the Federal Reserve will raise interest rates next month. Okay. I don't know why they keep putting that disclaimer in there, like the Fed's not going to raise interest rates next month. If they didn't, that would be a huge sign of something majorly wrong. And I think the market would just collapse based on that news. This is further evidence of persistent and increasing embedded inflationary pressure that should keep the Fed leaning towards even more hawkish policy, said Andrew Hollenhorst. That's a cool name. Chief U.S. economist at Citigroup in New York. We continue to expect data over the month will support a 50 basis point hike by the Fed in March. The producer price index for final demand jumped 1% last month, the biggest advance since May after climbing 0.4% in December, said the Labor Department. The PPI was boosted by a 0.7 increase in services, matching the gain in December. Services were driven by a 1.6% rise in the cost of hospital outpatient care. There were also increases in wholesale retailing for machinery, vehicles, apparel, jewelry, as well as footwear. The cost of hotel and motel accommodation rose, as did freight transportation by trucks. Portfolio management fees jumped 1.9%, but margins for fuels and lubricants retailing fell 9.7%. Airline fares dropped 4.2%. Wholesale goods prices rebounded 1.3% after dipping 0.1% in December. A 0.8% rise in the price of goods, excluding foods and energy, accounted for more than 40% of the broad increase in cost of goods. Motor vehicle prices rose 0.7%. Food prices advanced 1.6%, while energy prices increased 2.5%, but prices for iron and scrap steel fell 10.7%. Healthcare and portfolio and airline fares are key components in the calculation for personal consumption expenditures price index, one of the inflation measures watched by the Fed. In the 12 months through January, the PPI rose 9.7%, followed by a 9.8% surge in December. Year-on-year PPI is slowing as last year's large increase drop out of the calculation. Economists polled by Reuters had forecast the PPI would gain 0.5% on the month and advance 9.1% on a year-on-year basis. Stocks on Wall Street were trading higher as Russia's, okay, all right, we know all about that, and inflation. So obviously the price of goods is still continuing to climb. Like I've said this, I don't know, probably 50 times now. Until interest rates go up to a significant amount, we're going to continue to see this increase in costs. While some things are going down, like scrap steel and of the like, the overall cost of goods for the general consumer is just continuing to get more expensive. All right, another article here. Can I contribute to an HSA after I retire? It's written by Eric Reed. This was published yesterday. So this is a pretty long article. I'm not going to read through everything, but I'm going to describe what an HSA is and get to the meat here. An HSA, or a health savings account, is a form of tax-advantaged retirement account designed for healthcare spending. You can make contributions to your account at any time, so long as you aren't enrolled in Medicare. During any period when you're enrolled in Medicare, you cannot make contributions to a qualified HSA. If you have other questions about retirement savings and healthcare, it may be a good idea to talk to a financial. What is an HSA? It's a tax-advantaged retirement account that shares features of both a 401k, an IRA, and a Roth IRA. Like a 401k and IRA, the money that you contribute to an HSA is fully tax deductible. You don't pay federal income or state. You don't pay federal or state income taxes on this money, and can even deduct it from your payroll. You can build an HSA either individually or through an employer. With an individual plan, you would make contributions yourself, then make the relevant deductions on your end of your taxes. With an employer plan, your payroll department could make HSA contributions and tax adjustments in the same way that they do with your 401k. Employers who run an HSA program can also make contributions for their employees. In addition, like a Roth, withdrawals from an HSA are tax-free so long as you use the money to pay for qualified medical expenses. This includes all of the account gains over time, meaning that the pool of money completely untaxed, meaning that you have a pool of completely untaxed money available for medical spending. All right. So what to contribute to an HSA, you have to meet these three criteria. You must not be enrolled in Medicare. You must not be claimed as a dependent on someone else's taxes, and you must be enrolled in a qualifying high deductible health insurance plan with no other form of health insurance. All right. So post-retirement contributions. So let's see here. Where is the details? All right. So someone who wants to keep making contributions after retirement can either do so by not enrolling in Medicare or by withdrawing from the program. While rare, both are options. However, it is unlikely that this would make any sense financially. In most cases, Medicare offers more in terms of dollar value than a health savings account would. So that's basically it. So, if you're, if you want to continue to contribute to an HSA, and you're retirement or you're over 65, you would either have to withdraw from the Medicare program, and also not be on a dependent on someone else's taxes. So I guess that pretty much answers that question. So I guess the time to contribute is while you're in your working years. Just like a retirement account for just like a retirement account, you use it, in the years that you are no longer working. You want to fill up that HSA as much as possible during your working years. And then, when you're older, use those funds tax-free for medical costs. All right. Last article I got, How to Retire at 59, a step-by-step plan by Mark Hendricks. All right. The 60s are probably the most common age that Americans retire during. Retiring at age 59 is possible, though, with some proper planning. For most people, once they've turned 59 and a half, they can begin withdrawing from their tax-advantaged retirement accounts without penalty. However, under certain circumstances, you can even withdraw penalty-free from these accounts at age 55 using the rule of 55. Preparing to retire by age 59 calls for evaluating the amount of income you can produce in retirement, estimating the expenses you expect to incur, and how you can make up for any shortfalls. Start your earlier retirement planning effort by projecting how much income you can generate in retirement. By beginning here, you'll have an idea of what kinds of decisions you can make in regarding to your retirement. For instance, let's say you have a family in New Jersey that you'd like to retire near. New Jersey is a notoriously high-cost state, so it would be helpful to understand your income before you choose to move there. Here are some major sources of income you might use in retirement: Social Security, tax-advantaged retirement savings accounts such as IRAs and 401ks, pension plans, savings accounts and CDs, taxable investments such as stocks, bonds, ETFs, and the like, home equity, wages from a part-time employer, inheritances, annuities, and cash value life insurance, and rental income. All right. How to retire at 59, budgeting your expenses. After assessing income producing potential, estimate your post-retirement expenses. This is where many of your retirement decisions will be made, as it should be quite obvious what areas and types of homes you'll be able to afford when accounting for these costs. Here are some common expenses retirees face: housing, such as rent, mortgage, utilities, insurance, and the like; healthcare, taxes, they never go away; food, groceries are an unavoidable cost, and dining out is an expensive cost; transportation, so the cost of owning a car or using public transport; miscellaneous, these are things such as cable TV, streaming services, magazines, newspapers, theaters, all alike; and other costs, helping kids with college, and or you want to contribute to a charity. All right. Rather than preparing a detailed budget, you can take a percentage of your pre-retirement income and use that as a rough and ready estimation of your post-retirement spending. Many advisors recommend using 60 to 80% of your income before retirement as a guide, and how much you'll spend after leaving the workforce. Me personally, what I like to do is actually just take several months worth of average spending. If someone's using software like Mint, or like in the old days, Microsoft Money, there's a lot of those apps available to you that you can categorize and track your inflows and your outflows. You do that for 90 days or 6 months, gives you a pretty good gauge of where your money's going, how much of it is discretionary, how much of it is, things that you absolutely have to have. And, you can also cut things out. Maybe you spend too much money at Starbucks. Maybe you go out to eat too much during the workday. So there are ways to look at that and say, gosh, I didn't know I was spending X percent on this or that. So by using that, then we can look at it and see, all right, well, which are the things that you're not going to have in your working years? Yeah, you're probably not going to be driving, 200 miles a week or 300 miles a week, whatever it is. If you're driving across town, you may not, spend as much on dry cleaning or whatever work associated costs that you might have. Those disappear. So, you can cut those out and really get a better idea of what your lifestyle spending is. Granted, it's going to change a little bit from year to year. But that, to me, is probably the easiest way to do it, because you really don't have to think about it until you have a lot of data, and then you can go back and sort and categorize everything and really get a clear picture. All right. Retiring at 59 or retiring at age 59 isn't like retiring at other ages, particularly because of Social Security. It's often more challenging than retirement at 62 or older. Of course, each person's own situation is unique. So what feels like near impossibility to one can seem like a breeze to another. Here are some major factors to consider. Social Security. You can't claim Social Security benefits before age 62 unless you qualify as disabled. The average monthly benefit in 2022 is $1,600, or I'm sorry, $1,657, and the maximum is $4,194. Medicare, this will cover your healthcare costs once you reach age 65. Before then, you'll need to find insurance in the private sector. You may be able to pay to keep coverage for a limited time under your previous employer's plan. After that, options include paying for one of the plans offered through the under the Affordable Care Act. And having purchased some of those plans when we were doing some job changes, a decade or more ago, those plans suck. So, especially those temporary ones that get you to the end of the plan year, they're not very good. Retirement account withdrawals, planning, after 59 and a half, you can withdraw from tax advantage retirement plans without penalty. Again, if you quit or are laid off or fired from your job during the year you turn 55 or later, you can make penalty-free withdrawals. Also, life expectancy. One of the most important factors of retirement planning is how long you expect to live after retiring. You can use Social Security's basic life expectancy calculator to get an idea. Probably look at your parents and your grandparents, see how long they lived, and were they unhealthy people? Did they smoke a lot, drink a lot, or were they really healthy? It kind of gives you an idea of how long you expect to live. All right. If your income and expenses figures are matching up, you'll need to either increase income or reduce expenses to fill the gap. Here are ways to do that. Generate income, save more. The bigger your retirement nest egg, the more income it can produce. To take advantage of the compound interest, start saving earlier. Max out tax advantage retirement plans, especially those that feature an employer match. Take more chances. Adopting a more aggressive investment strategy potentially can increase the size of your assets at retirement as well as the ability to generate income. Now may not be the time to be taking more risk. I'm just saying, with the volatility in the markets right now and the likelihood of some sort of a retreat, I don't know if taking more chances right now would be a good idea. Work part-time. Many retirees choose to work part-time to generate more income. Reducing expenses. Where you retire can affect your ability to retire. The cost of living in Mississippi, for instance, is half the cost of living in Hawaii. Pay off debt. If you pay off your mortgage, you can probably retire sooner because housing costs are a major expense for anyone, including retirees. The same goes to a lesser extent for auto, student, and other loans. All right. So that's there's a little bit left. I'll go ahead and stop there. So that's everything I had for today. So I hope everyone has a fantastic evening. I know I am. I'm going to enjoy a pepperoni black olive pizza. That's my birthday dinner to myself. And hang out with the wife. She will probably watch some Survivor, she's really angry right now because Australian Survivor got yanked off of Paramount Plus right in the middle of watching it. So I personally, I just sit there and listen to podcasts while she watches it. But she was quite hot. So if anyone knows anyone at the Paramount company, feel free to raise some hell on behalf of my wife. Anyways, all right. Well, hope everyone has a great night, and I will be back tomorrow with the Liberty Call for Wednesday. And we got a big snowstorm coming through tomorrow afternoon. So yay! I get to break out the snowblower another time or one more time before the winter's over. So, all right. Well, everyone have a great night, and I'll see you tomorrow. Bye.